Central bank buying has really been the main driver of gold for the last 3 years, as pretty much everyone knows. And, what we've seen in the last few years from the central banks is really, and I want to emphasize this, it's really a continuation, an acceleration, but a continuation of what's been going on for the last quarter century. Central banks have wanted to move away from a concentration in a single asset, the US dollar, that is the asset of a fiscally irresponsible government and a government that's willing to weaponize that dominance. So the central banks, in my view, are going to continue to buy simply because they want to reduce their exposure to the dollar. We're not buying silver yet. I think we have, on a risk reward, I don't think we're going to miss out on much if we wait, 4, 6, 8 weeks.
Gold's rally is no longer just a price story. It is becoming a reserve, a currency, and a confidence story, with central banks quietly setting the tone for what private investors may follow next. Ted Oakley, a veteran investment manager known for his cautious capital allocation, and Adrian Day, a respected resource stock analyst with deep experience in gold equities, argue that the move away from dollar concentration is a structural shift rather than a passing reaction. Central bank buying should continue to support gold because the motivation is simple: reduce dependence on an asset controlled by a government with rising debt and geopolitical leverage. Short-term selling from Turkey or Gulf states may still appear during liquidity stress, but the broader trend remains intact. That makes dips more likely to attract patient buyers than mark a final top. The stronger prediction is that gold remains a preferred reserve asset while the dollar share of reserves keeps grinding lower. Silver could lag briefly, yet waiting for a cleaner entry may prove wiser than chasing another emotional spike. That patience has value now. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Well, the central bank buying has really been the main driver of gold for the last 3 years, as pretty much everyone knows. And what we've seen in the last few years from the central banks is really, and I want to emphasize this, it's really a continuation, an acceleration, but a continuation of what's been going on for the last quarter century. Central banks have wanted to move away from a concentration in a single asset, the US dollar, concentration in a single asset that is the asset of a fiscally irresponsible government and a government that's willing to weaponize that dominance. And so the move away from the dollar as a percentage of central bank reserves has been going on for 25 years. Now, it's accelerated. It obviously accelerated dramatically after the confiscation of Russian assets over the Ukraine invasion. So the thing I want to emphasize is this is a long-term trend. I think it's fair to say that nothing that the current administration has done has assuaged any of those concerns, but it didn't start and it won't stop with the current president. So we've gone from basically 75% in 1999 of foreign central bank reserves were held in the dollar. And as you know, now gold has actually overtaken, according to the ECB, gold has actually overtaken the dollar in central bank reserves. So I started by talking about central bank selling of the dollar. But when you sell the dollar, especially when you sell the dollar because you're worried about fiscal irresponsibility and you're worried about possible confiscation, then gold is the obvious asset to buy because you're buying an asset that is no one else's liability. Are you going to switch from the dollar to the euro? Are you going to switch from the dollar to what else? To the British pound? And so so we've seen a little bit of that. So it's certainly not commensurate one for one, but it's selling of the dollar and buying of gold. But it's probably 80 to 90%. We've seen a little bit of buying of the yen, a little bit even of things like silver. Saudi Arabia owns some silver in their reserves. We've seen a little bit and we've seen, of course, central banks taking direct positions in assets. Particularly China has done that. Switzerland, of course, famously or infamously, I should say. runs a hedge fund in the US stock market for its bank reserves. But most of it goes into gold because the gold is an asset that is no one else's liability. And remember, the gold prior to 1999, so last century and the century before, gold was the dominant asset in central bank reserves. So this is not new. So that's been the main factor. And then the question is it going to change? Well, we look at the first quarter of this year. We had some dramatic, very high-profile sales of gold by central banks in March after the Iran conflict started. Notably, Turkey, of course, which sold almost 60 tons in 2 weeks, very haphazardly. That's a lot of gold to sell in such a short period of time. And they were selling because of pressure on the yen, pressure on the lira. So anytime you have a military conflict somewhere, you have liquidity concerns, whether they're global or whether they're just regional. And so we saw Turkey sell, we saw the Gulf states sell. We also, of course, saw Poland and Russia sell. But it was primarily in the Gulf area directly affected by the Iran conflict. But notwithstanding that, we still had net buying in the first quarter. And we had buying in the first quarter, net buying in the first quarter, that was higher than any quarter since the end of 24. Then in April, we had net buying again. We don't have May's numbers yet. So the central banks, in my view, are going to continue to buy simply because they want to reduce their exposure to the dollar.
Do you think part of that selling in the first quarter, off of that 5,500 high was sort of hot money getting out, because they chased it right at the end of the year?
It definitely was among investors. It was also, I won't call it hot money. It was also, long-term value-oriented investors who made the right call to take some profits off the table, including people, in the gold fund, small institutions and people in the gold market. But of course, the central bank selling was not hot money. Central banks are quite the opposite of hot money.
But it seems like we had a lot of people chasing it in the U.S., for example, toward the end of the year.
Oh, no question. Oh, the move in December, January was idiotic, and we can say that even more clearly when we look back. Silver even more so, of course. Silver even more so. And I have to say, we did sell a lot of our silver in January.
Yeah. So let me ask you, on that silver, since you did sell a lot, are you buying it back?
Two things. We're not buying silver yet. I think we have, on a risk reward, I don't think we're going to miss out on much if we wait, 4, 6, 8 weeks. We may not see it much lower, but I think the probability is that, waiting will be the right thing to do. When it comes to the equities, which is what we primarily do, we have to step back a bit. I'm sure that there are very few pure silver. Well, there's very few pure silver mines in the world. Therefore, there's very few silver producers or explorers. There's a few pure silver explorers. But in terms of producing companies, there are not a lot of pure silver miners. And so, frankly, I look at gold silver miners as one group. And you look, a wonderful example is Pan American Silver, which is the second largest silver producer in the world. And yet last year, less than 20% of its revenue came from silver.
Oh, okay.
Yeah. So
would you put Hecla in that category?
No, Hecla's got a little more silver. Coeur d'Alene now. Hecla didn't used to, but it does now. Coeur d'Alene is primarily silver. But even something like First Majestic, which people think of as a silver company, their foundational mine, Santa Elena, it was silver, but now it's moved into a part of the deposit that's primarily gold.
Gold-backed stablecoins could become an overlooked source of demand if users in unstable currencies prefer a digital claim tied to metal rather than Bitcoin or dollar tokens. The logic is practical. People want liquidity, portability, and protection from local currency weakness. If adoption grows even partially like dollar-backed stablecoins did, issuers would need to hold physical gold against new tokens, adding a private sector buyer besides central banks. That does not guarantee a straight-line increase, because trust, audits, custody, and regulation will determine whether users believe in the backing. Still, the idea matters. A large issuer buying gold to match token growth could tighten available supply, especially when official buyers are active. This could make gold's next advance less dependent on Western retail enthusiasm and more driven by global currency pressure. That shift would be powerful if confidence continues to erode worldwide. Now, let's get back to the interview.
How gold tokens or gold is a backup currency, I'm assuming, for stable coins. You might talk about that a little bit.
Yeah. So I'm not a crypto person. That's not my wheelhouse.
No, we aren't either. So
you probably don't want to get me started on what I think about most crypto. The stable coins, theoretically, as you know, a stable coin is a crypto coin that is meant to be 100% backed by something. And the most obvious stable coins are US dollar stable coins. So Tether, which is a private company, it's based in El Salvador of all places, but the backers are from Italy, from other places in Europe, and from Uruguay. But it's a private company. They're now something like the 8th largest holder of treasury bonds in the world. I mean, when you think about that, especially when you think that the Federal Reserve and Social Security are number 1 and 2, that's pretty astonishing to have a private company that 3 years ago hardly anyone had ever heard of. I hadn't, as your number 8 largest holder of treasuries. Now, a year ago, they started the gold stable coin, which is a crypto coin that is allegedly or meant to be 100% backed by gold. And the chap that's the head of global projects for Tether, the chap that runs this, he's called Juan Santori from Uruguay, actually. He thinks, this is, what his projection, he thinks, not a plan, but the gold stable coin will grow as rapidly over the next 5 years as the US stable coin did over the previous 5 years. And his reasoning for that is that twofold. Virtually all of the buying of the US stable coin is foreign. I mean, if you're a US person, you're not going to buy a crypto coin backed by the treasury that doesn't pay you any interest. But if you're foreign and you want something that's highly liquid, you can move it out of the country, your currency's collapsing, then it makes sense. His argument is that if you ask a Venezuelan or a Nigerian who wants to get some money out of a country or just wants to save some money in something other than their local currency, which is depreciating dramatically, and they're not allowed to hold US dollars, if you offer them, well, you can have Bitcoin. Well, that's collapsed 50% in the last few months. Maybe not a good idea. You can have the US dollar, which of course fell last year, this year not, or you can have gold. His response is, or he thinks that a lot of people will choose gold. Will it be half of them, a third of them, whatever? But a lot of them will choose gold. In addition, of course, a gold stable coin makes sense for US people who want to save small amounts of money in gold. Some people actually want to use it to spend their gold. So with a crypto coin, you can do that. So anyway, the net result is that they started the gold-backed stablecoin about a year ago. They have high expectations for it. That doesn't mean it'll happen. And in the last 3 quarters of last year, since they started buying, in the last 3 quarters of last year, Tether bought more gold than any central bank. That is just astonishing. And if they're doing it properly, of course, every time they sell 1 million ounces, a million gold-backed stablecoins, they have to buy 1 million ounces of gold to back it if they're doing it properly. So I think that might, yeah.
Let me switch on you here. You have two companies I really like, but you go at a little different direction. But I'm going to talk. First company is Agnico Eagle. And I think you're really high on this company, but you might talk about it a little bit.
Yeah, well, Agnico is now the second largest gold producer in the world, has overtaken Barrick. I am, very, very keen on Agnico. The management is incredibly strong. One of the things that impresses me an awful lot is anytime I have a meeting with the management, there might be 6 of them, there might be 16 of them, but every single one of those is a star, with many of them of the potential to be a CEO. They only operate in low, politically low risk jurisdictions, so Canada, Australia, Finland, and Mexico. Some people might scratch ahead of Mexico, but in the context of global mining, that's worse than it was, but is by no means a bad jurisdiction. But primarily Australia, Canada, and Finland. They have a very strong balance sheet, very strong disciplined management, a huge pipeline of organic growth. So no, I like it a lot. And the valuations, the astonishing thing is that the valuations are still very, very low. Oscar Wilde said most people know the price of everything and the value of nothing. And so people look at the gold stocks having gone up so much in the last 2 years and they think, oh, they must be expensive. What they miss is that the price of gold went up so much more dramatically than did the cost of mining. And so for a company, Agnico, for example, they're what's called all-in sustaining cost. That's not the operating cost at the mine level. That's their all-in sustaining costs, which is a global benchmark for, assessing costs, is less than $1,350 an ounce. $1,350. So yeah, they were making much more money at $5,500, but they're still making good money at $4,000. Those margins are astonishing. Now, as you have those margins, of course, you have cash flows expand, and then they can pay down their debt. So you have free cash flows expand. And so if you look at the valuation of a company like Agnico, I like to look at price to free cash flow. That's my favorite metric for miners. Of course, I look at a lot of things, but that's, my favorite metric. They are selling within a hair of their all-time low price to free cash flow, which to me is just astonishing.
The mining stock angle may be the most mispriced part of the story. Many investors see gold equities rising and assume they are already expensive, but margins tell a different story. When gold rises faster than all-in sustaining costs, free cash flow can expand sharply even if the metal stops making headlines. Companies with strong balance sheets, disciplined leadership, and low-risk jurisdictions should be positioned to benefit first. Agnico Eagle stands out because its cost base, project pipeline, and political footprint give it more durability than many peers. If gold holds elevated levels, valuation measures such as price to free cash flow could improve without needing a speculative frenzy. Silver may need more patience, especially after a fast move. But the scarcity of pure silver producers means many investors will still express the trade through mixed gold and silver miners. The likely outcome is a rotation from metal strength into quality mining shares, with pullbacks creating better entries than panic exits. In that environment, patience and balance sheet strength should matter more than simple metal exposure by itself. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.